Well, great. We're at the top of the hour. We should probably go ahead and kick it off. I welcome everyone to join us on one of our client webinars. We're talking about wealth management, investment strategy, and other life and money type topics. We've been having a really good time with this, and excited to have Roz and John from Vanguard join us, as well as clients will be listening in, tuning in later. Vanguard is a company that has to be one of the most familiar names in the business, and long reputation as a real champion of the individual investor. And I think we'll talk about some of those unique points in a moment or two, but very excited to have Roz and John here. They are some of the analysts and executives who work directly with us in our connection when we're working with Vanguard. But by way of disclosure, it's important to point out, our compliance team always wants us to, that there is no connection. We're not agents or representatives or owned or employees of Vanguard, and their opinions and ideas are independent, and vice versa. Vanguard is not employed by us or represented in any way. So we're here just by mutual association. Also, we will be talking about the markets and the economy and investment ideas, but want to make very clear that nothing that we talk about here is intended to be direct, personal, individualized advice. It's general commentary. So, please give us a call at the office if you want to talk over specifics. But Roz Beliveau, I got it right there, Roz? Is that close?
You got it right. Yep, absolutely.
Okay. Very good. So Roz is fantastic. She and I have had connections and conversations for many years, and always very helpful in terms of helping us think about the markets and different offerings and how to employ the different types of building blocks, if we do so, that Vanguard builds, and the different research and capabilities that Vanguard has at hand. Very appreciative of that. And John, we're newer acquaintances, but chartered financial analyst with Vanguard and a market expert, and very happy that you're able to join us on the call as well and offer some insight there. So, I thought maybe we could start it off. Roz, in the past, we've talked, you've helped me really understand that Vanguard in many ways is a unique company. Like I say, in my mind, one of the first things that pops to mind is John Bogle and the history, and championing the individual investor, championing low-cost investing, diversified approach, index type approach. Maybe, for the folks on the call, could you share a little bit about Vanguard and the history of the company and what makes Vanguard unique?
Sure. I'd be happy to. And thank you for having us, Scott. It's wonderful to get to work with you and your team over at Cahill. So for those of you on the line that aren't as familiar with Vanguard, so Scott hit the nail on the head, right? Vanguard was founded back in 1975 by John Bogle, who had this really radical and unique idea. He really had two radical and unique ideas at the time, right? At the time, Vanguard didn't have an index fund when we were founded. So that came a couple years later. We started with the Wellington Fund, which dates back to 1929. But when he started the firm, he had this radical idea that an investment firm its interests should be aligned with its underlying shareholders. And when you're owned by a management company or you're a publicly traded company, your interests are aligned with that management company or with those that own your shares. You're always looking to generate a profit for this company. And John Bogle at the time said, I actually want us to be aligned with the end investors. And when they do well, we do well. Very, very similar to, I know, how a lot of financial advisors think about it. And so he created the first mutually owned client firm, mutually owned investment company. And so what that means is, instead of being owned by a separate management company, Vanguard is actually owned by the funds themselves. And so as owners of Vanguard funds, you all are owners of our firm. And so Vanguard's mission at the end of the day is to take a stand for all investors, to treat them fairly, and to give them the greatest chance for investment success. And the way we do that is by being client owned. I've been at the firm for 15 years. And when I say we take it to heart, and this isn't the case now, I live in Minneapolis. So Scott, I'm sure many of your clients that are watching this are local in Minnesota. I'm sure not everyone is, but I'm sure a lot are. So I'm local in Minneapolis, but I used to work at one of our sites, right? So back when I first started, we had 3 primary sites. We had a Scottsdale office, a Philadelphia office, which is in Malvern, and a Charlotte, North Carolina office. And when I used to be in the office, when you used to stand at the printer or the copier, the big Xerox machine, and you would be printing something in color, inevitably somebody would say something like, did you think you need to print that in color? That costs extra to print things in color. Is that in the best interest of our shareholders to waste that money on? Like, it was, the firm is, I don't want to say the firm is frugal, because obviously we've spent a lot of money over the past decade or so investing back into Vanguard, but the way Vanguard operates is really, really aligned with the end shareholder.
Mm-hmm.
A piece of that I think, Scott, is important to share with your clients and those that are listening is another piece of being shareholder owned is that we operate at cost. And so what I mean by that is the way most fund companies make money is they charge expense ratios on their funds, right? So all of your clients that hold Vanguard funds or any other fund, right, you pay an expense ratio, and that's the amount that essentially a company charges to operate the firm. And so Vanguard operates at cost, which means we charge you what it costs to operate our funds and essentially keep our lights on and pay our bills, et cetera. Any revenue that Vanguard generates above and beyond the cost to operate our funds, and like I said, pay my salary, pay John's salary, et cetera, we reinvest back into the funds in the form of lower expense ratios. And so you probably have seen, if you've been a client of Scott's for a while, the expense ratios on your Vanguard funds continue to go down. And that will continue to happen as Vanguard gets more cash flow, as we generate more revenue, we're able to reinvest that revenue back into the funds in the form of lower expense ratios, essentially meaning you keep more of your returns instead of paying us for those returns. And so again, it just goes back to the take a stand for all investors, treat them fairly, and give them the greatest chance for investment success.
Yeah, and I mean, it is Vanguard specifically, you do that. But I think one of the amazing things, even in the course of my career, I was very lucky, I feel like, as a finance undergrad, back in business school in the very early 90s, that happily I had some professors who really were influenced by research out of the University of Chicago and indexing and the index and the whole argument about efficient markets and passive investing versus active investing. So happily I was introduced to these ideas early on, but it was probably 20 years after the first investable index fund that Beliveau started. But even then, there was a lot of skepticism. It was not widely adopted, certainly not like it is now. But the amount of traction Vanguard has gained, but also pressure on the industry at large to lower expenses, to be investor focused, the incredible flood of assets into the more passive and index style of investing has truly been remarkable, both within Vanguard, but within the industry at large. I mean, it really has revolutionized the industry. Yeah.
I was actually just looking at some numbers, and I will caveat to say, and Scott, I know you know this, but so Vanguard is we were 8 trillion at the beginning of the year. I haven't seen an updated number. Maybe we're holding off a little bit. See if the market comes back before we give you a new number. But at the beginning of the year, we were around 8 trillion of that. 6.5 trillion of that is in index funds. 1.5 trillion of that is in active funds. So Vanguard is an active manager at the same time. The difference is Vanguard's asset weighted expense ratio. So essentially our average expense ratio for our index funds is 0.09%, right? So essentially for every $100 that you invest in Vanguard, you pay 9 cents. Whereas the industry expense ratio for index funds is 0.49%, right? So 49 cents out of that 100, which compounds, right? The more money you invest, the higher that goes. I was looking at some numbers recently that said Vanguard's average expense ratio for our active funds is actually 0.19%. So our active funds are still lower cost than the industry, and that's actually the same expense ratio that a lot of other fund companies charge on their passive funds, on their index funds. So Vanguard believes and operates at cost in this low cost fashion, both active and passive. But you're right. When you look at active versus passive, the cash flows over the last 20 years have just been exponentially going into index funds, and it's for a variety of reasons, right? The first and foremost is cost, right? People are voting their dollars. People aren't voting with their feet, they're voting with their dollars, right? More and more assets are going into lower cost investments because, again, instead of paying a management company, people want to keep more of their returns. The second piece is it's really hard to beat an index. And You mentioned John, my partner here, has his charter financial analyst. So it's called the CFA designation for shorthand. It's an incredibly hard and rigorous exam to get, right? John has to study for 3 years and take 3 separate exams, which have extremely low pass rates. John, what was the pass rate, do you know, for the one you just passed?
I think it was around 45%.
Yeah, so think about that. More than half of the people that studied for it didn't pass. And that's
And
level
most
3.
of those people already have an MBA or a finance degree and are working in the field. This is not like general population. These are
exactly. You can't just take it, right?
Yeah.
You have to. He's already done 2 years of tests, which much lower pass rates than the other exams, the other levels, because those kind of weed you out. When you get to level 3, we expect more people to pass. But I share that to say more and more people, especially in the investment world, 25 years ago, you had very few really bright, intelligent investment managers who could pick the right stocks. Well, now you have, even though it's a very low pass rate, you have more and more people that are getting their CFAs, that are moving into the alternatives world, the hedge funds world, et cetera. And so what it's called is the paradox of skill, right? When you have so many more bright, intelligent people focusing on trying to find the right stocks to pick, the ability to do so wanes, right? Because it's so much harder to do when you're in a pool of really, really intelligent people than when you're one of the smartest in the group. And so since then, when I look back just on a 1-year basis, 85% of active funds in the large cap space didn't beat the S&P 500. 85%. And think about that. So those 85% of the funds, they charged more, they probably paid off more capital gains, and they didn't beat the S&P. And so I don't think you should set a barometer to the S&P, but I share that just to say that there's a reason you've seen more and more money flowing into index funds versus active funds. And obviously Vanguard has both options available, but most of our assets, I would say, are in the index space.
Mm-hmm. Yep. Yeah, that's fantastic. I can already see we might ask you back for, a special focus really just on that whole concept of active and passive investing. And it's been an interesting one to watch over the course of my career. And like I said, very happy that I happened to have some good professors early on who I feel like pointed me in the right direction when it wasn't popular. But now we've almost come the whole other way around. And I think it is interesting to note that Vanguard does have a large active investing business. And I think that's kind of a secret, but very interesting structure with the ownership and like I say, consistent throughout the advocacy for the end investor and really the ownership there. So yeah, thank you for that, Roz. John, we're lucky enough to have you on the call, and I think would like to hear some thoughts from yourself, from your company, in terms of what's happening. It's been an interesting year. Can you bring us up to speed? What's been going on?
Yeah, happy to jump in, Scott. It definitely has been an interesting year, to say the least. I know people that at the beginning of this year weren't tracking the markets, weren't following that closely. Now I've had to track closely because their account balances have changed, because they've been paying more at the pump, more at the grocery store. So it certainly has been an interesting year. And before I comment on kind of where we are, I think it's important to take a step back and look at where we were to frame the moment in time now economically. So I'm going to take us back to 2008 up until 2020, that 12-year period. The US economy actually had its longest ever economic expansion. I saw it was 128 months, which is the longest that it has ever expanded. So the post-2008, post-global financial crisis, the period was characterized by low interest rates, low inflation, low unemployment, and high market returns. So what you should think hearing that is that things were good. And it almost feels like now, when things aren't quite as good, it's looking back on it with a little bit of the glory days kind of twist.
Right.
As we saw in 2020, the pandemic sent an unforeseen shockwave through how we live our lives, how we work, and how the economy ultimately functions. So like I mentioned too, in that 2008 to 2020 period, the good times, we'll call it that, all of those employment gains, so low unemployment, leads to more people in the workforce, leads to economic prosperity. They were all wiped out within months during the COVID crisis in 2020.
Mm-hmm.
So as the COVID crisis hit, the economy all but faltered and stopped running. Now, the relationship between the economy and what we do is we won't just kind of sit back and say, oh, this is happening. How do we change this? There's a central bank. So the Federal Reserve, Jerome Powell, I'm sure you've seen him in the news. They have taken the mantle to really stimulate the economy and what we call as a dual mandate. So they have the goal of price stability. So that's low inflation, price stability, and economic growth. So to reach those two goals, typically how they enable that throughout the environment is changing interest rates. So back in 2020, that spring, Jerome Powell and the central bank wanted to stimulate the economy, so they lowered interest rates. Lower interest rates, and both my parents are teachers, so I had to explain it to them as it was happening. And I don't take it for granted that everyone understands how they operate. But basically, when you lower interest rates, you stimulate investment from households and businesses because it makes it a little bit more easy and affordable to borrow money.
Mm-hmm.
So Jerome Powell had that as his thesis, to lower interest rates to stimulate growth. Well, the Fed's plan worked.
Easier
exactly.
to borrow and less attractive to leave money sitting in a bank or a CD because it's not doing anything, but very easy to borrow at a low rate and buy a piece of real estate or invest in your business or just go buy things in the economy, right? Yeah.
Exactly. That's exactly it. So you want to stimulate the purchase of goods, the investment into properties, businesses, and that's really what happened. The economy got the engine going again, and we saw that his plan to lower interest rates worked. Now, remember, I'll say that like there's no such thing in investing or in life as a free lunch. And I'm going to use an example here because just before this, I was eating lunch and I was thinking about spending time with my grandmother. I call her Mom. Roz knows her well. I talk about her a lot, but she loves daytime television. She loves watching either the news or the soap operas. And one thing I notice about commercials during daytime television is that a lot of them are for pharmaceutical companies. So selling new drugs or whatever. And at the end of the commercial, they always say, and the purpose of this drug is to relieve back pain. Side effects may include headache, nausea, back pain, a number of other unintended side effects.
Right.
Now, I say that because as Jerome Powell lowered interest rates, there was the risk of unintended side effects. Unintended side effects in this case are an overheating economy and high inflation, which now with the view of perspective, we can see happen. Those risks materialized, and we currently stand in a precarious situation with high inflation and an overheated economy.
You know, one thing that I think about sometimes too, John, there's this idea, and I always think of Alan Greenspan, talking about the Fed chair, the maestro, and the idea of him, very finely tuning interest rates to, keep the steady hand on the tiller of the economy. But, you can go back to very old investment books and economic books, and there's this idea of the business cycle, kind of boom and bust cycles, and then also the kind of concept of creative destruction. And so, it's just interesting, how much of this is manageable and how much of it is sort of natural cyclical nature of markets building up, attracting attention, the age-old fear and greed cycles that, we can see reference to and warnings of going back thousands of years, really, in terms of markets and commerce. So it's, I always wonder about that somewhat. Clearly interest rate management matters and we see the impact of that, but sometimes I wonder how much.
Yeah.
Mm-hmm.
It's definitely an interesting aspect. I actually listened to a Planet Money podcast the other day, and they talked about the changing role in the Fed, and people think back to Paul Volcker,
Right.
who was the first Fed chairman to really have a hard hand in quelling inflation at the expense of the economy. certainly the Fed has evolved over time. But when I think about where we are now in terms of like economic, financial conditions and where we want to go, the power and the direction sits within the Fed and their decisions. So it's interesting to see how closely everyone follows what their posturing is, whether or not something is phrased a certain way at a press conference, to determine whether or not the Fed will be more dovish, so kind to the markets, or hawkish, which is more aggressive in taming inflation.
Well, on that, I think there's a lot of discussion at this point. Paul Volcker, I think, is maybe a great reference point. The idea that we had inflation skyrocketing in the late 70s, 1980, 1981. Paul Volcker came in with the idea and the strong hand of saying, we're going to let interest rates climb, the opposite of what you're talking about, to hammer the brakes on the economy, to make it very expensive to go out and borrow money, and to make it much more attractive to buy a certificate of deposit that pays 12, 15% or whatever you could get. You hear these crazy stories of money market funds paying 15% in that era. And it worked. It slowed the economy, right? And it broke the back of inflation, is the famous saying. And it also put us into a short recession. And it seems like that's where we're at now. And that is, you talk about the Fed and that dual mandate. They seem to be sort of trying to walk the line between controlling inflation and not letting this get out of control, and making sure that it's tamped down and not lifting the foot off the neck of inflation too soon, and steering us into a recession. And I guess it's just Friday, Powell made comments to that effect, and they're going to, likely raise interest rates again, seem to be the indication to really try and keep the brakes on inflation. But then there's this risk of recession. Are we in a recession? How bad will it be? What are your thoughts? What are you seeing in terms of both, inflation and recession, as we look forward? We talked a bit about what we've come through.
Yeah, definitely. Inflation and recession. I actually, as I think about it, it's probably what I talk about the most at work every day. And I'd love to see that Google chart of like the spikes in how often people Google certain words.
Oh, yeah.
I would have no doubt that both inflation and recession would have a large increase.
Yes.
I'll be happy to tackle inflation first, and kind of our thoughts and some experiences there. So as we all know, inflation is nothing new to us at this point. And I'll start out with a quick personal story here. So Scott, I actually saw on LinkedIn that you drive a Toyota with a lot of miles on it. I do as well. I drive a 2008 Toyota Camry. I've driven it for about 9 years. And all throughout that time of driving it, it would cost around 35 to 45 bucks to fill it up. In June, I paid $80. And I almost had to look twice at it. I'm sure everyone listening has experienced a similar situation here. My point is that inflation hurts. And I don't come bearing news of, hey, inflation's going to go away, everything's going to be fine tomorrow. It's going to take time, and it may take a little bit of uncomfort. What we expect for the rest of the year in terms of inflation is headline inflation. So that includes energy, gas prices, along with the rest of the basket of goods, to remain elevated at around 7% through year end. And there are two reasons why we expect inflation to remain elevated through the end of the year. The first is a tight job market, and the second is supply chain constraints. So thinking about a tight job market, again, it's very competitive right now. There was a statistic at the beginning of the year that said for every 2 open jobs, there's 1 applicant. An example that I think illustrates this is actually, so this summer, I spent a little bit of time with my mom at her shore house in southern New Jersey, not too far from the beach, spent some time at the beach, and each block, there's a lifeguard stand. I have a couple friends that are lifeguards, and for the past 20, however many years I've been coming down, there's been 1 lifeguard stand per block and 2 lifeguards sitting on the lifeguard stand. This past year, with everything we've seen in the tight job market, there's been a change. There's been one lifeguard stand for every 2 blocks and one lifeguard per each stand. Now, I think about a tight job market. One of the best jobs and one of the coolest jobs that you can have is being a lifeguard, sitting on the beach all day. And they were even having trouble finding enough people to fill those spots. So we expect wage-based inflation based off of a tight labor market to persist. The second piece of that is supply constraints. So if you've ever ordered anything recently, whether it's a big piece of furniture or an appliance, there's likely been a lot of delays. You probably paid more for it now than you would have 2 years ago. We expect the supply constraints to persist and lead to, again, a driver of higher inflation. So to kind of summarize that, inflation, we believe, will persist, and it's driven by supply constraints and a really tight job market.
Yeah, excellent. A couple thoughts came to mind as you're talking about that. In the job market and the labor market, I just was mentioning in conversation with my wife the other day, we were talking about this exact thing and hiring and employers saying it's hard to get people, and where are all the employees and the people want to work and what's going on, and quiet quitting and these different types of concepts. I mean, I can remember clearly after the global financial crisis, which you took us back to in 2008, they talked about the slowest recovery on record, the jobless recovery coming out of that. And I can still picture it. I think it was about 2010 when the first time I saw a help wanted sign in some shop window. I thought that was remarkable because it had been so long, for anyone who wanted, needed an employee, and we're feeling like it was gaining traction. So we're definitely, seeing the other side of the spectrum here. Interesting. And I have to say on the lifeguard thing, so you just referenced seeing a post of mine on LinkedIn. I do try and share things of interest there. There was a fantastic article just a week ago I shared from Wall Street Journal about a fellow who had been an anesthesiologist and was retiring at age 67 and was trying to think of what he was going to do. Realized he needed something engaging, and was pondering this for quite a while. What was he going to do in retirement? And he thought back and said, boy, my favorite job, or one of my favorite jobs, was when I was a lifeguard. And so it's this great story of how he spent about a year because he got in contact with them, and they said, well, okay, we'll hire you, but you have to pass the physical requirements. And he talked about how he always felt like he was in good shape for his age, but the whole process he went through to train for, he lost 40 pounds, and he had to get his swim time and his running time and all this stuff down to certain standards. And it's really a great article, but just shared that, I think, last week on my LinkedIn profile. But yeah, very interesting stuff, John. And, managing money is a big part of what we do, but we're very much financial planners and do that in the context of financial planning. And looking at people's assets and their expenditures and their future goals and trying to tie that all together. And a big piece of that puzzle has always been inflation, assumptions around inflation. And for a long time, we talked about what we're building in for inflation assumptions, and people just kind of smile and nod their heads because inflation was almost nothing for about 10 years, right? I mean, we're really almost flatlined, but we'd model shocks in terms of inflation. So there again, for people listening, when we've gone through those scenarios, we have contemplated these types of events. We're looked at historical situations like the 70s, like other periods where we've had high inflation. And so it is something that we think about not only in the portfolio design, but also in the planning. So, well, what about the other side here? The risk or the reality of recession, the other side of this inflation concept. What are your thoughts there?
Yeah, I am happy to share. I think it's a great question. I do want to come back to your story about the 67-year-old man who's going back to the workforce, because it does tie into some thoughts we have. So I love that you brought that up, Scott. To first look at a recession, I think it's important to frame what is a recession. So some countries define a recession as 2 consecutive quarters of contraction. In the US, a recession is defined by the National Bureau of Economic Research, NBAR. So NBAR looks at a number of different factors, and two of the key drivers are labor market and industrial production. Right now, they're strong, and we expect them to continue being strong. Like we mentioned, it's hard to find a job, tight labor market, and our industrial production and our economic growth is increasing. So in the near term, we do not expect the NBER to declare a recession. That being said, and I'm going to share my screen because it's a cool graph to illustrate. And forgive me, I'm not the best with Zoom. Can you guys see my screen now?
Not, well, we see you still. Let's see.
Still don't see me.
There we go. Looks like it's,
Okay.
yep.
Here we go. So here's a visual of our expected chances of a recession in the future. So I'll share and say what's being shared. So over the next 12 months, we estimate about a 25% chance of a recession. And then over the next 24 months, so the next 2 years, we estimate a 65% chance of a recession. So a lot of people see this and they get a little skittish. They go, oh my gosh, a recession, it seems like a pretty high probability. I wouldn't want to take that chance, even if there's only a 25% chance in the next 12 years, excuse me, next 12 months. So I want to pause and then share our expectation in terms of how bad it will be. So recession severity, what will that look like? We expect that if we were to go into a recession in the next year or 2 years, it would be a shallow recession. So more similar to 2001. When I think of a recession, when most people think of a recession, they think of the global financial crisis and they think of COVID in 2020. And when you think about what precipitated those two recessions, it was an exogenous external event that caused the contraction in the recession we saw. Nowadays, we don't have a exogenous external event like that to drive a recession. We simply have an overheating economy and too high of inflation. So thinking about how bad the recession will be, if we go into a recession, it will not be as bad as 2008, will not be as bad as 2020. The intent of this rate hiking cycle is to quell inflation, and inflation is hurting Americans. And me, my parents, my family, you, everyone is being felt by inflation. Now, the next question that always comes up is, all right, you know, it's not 100%. We're not 100% in a recession right now, not 100% over the next year, next 2 years. What do we have to do to avoid a recession? There are 4 main things, and I'm going to read out what they are, and then I'll share a quick blurb on that. So the first is lowering inflation expectations, oil remaining under $100 a barrel, increased real inventories, and then more Americans returning to work. A couple that I'll point out here is the first, so lower consumer inflation expectations. Inflation is a self-fulfilling prophecy. If I'm thinking about buying a couch and I can go into the store and I can see it's $1,000 right now for a couch, but I think that inflation is going to continue. I think that in a month, the couch is going to be $1,100. I'm going to buy the couch now, and that the act of buying the couch is going to reduce supply and increase demand, which further increases prices. So inflation is a self-fulfilling prophecy. When I talked earlier, yeah, jump in, Scott.
Well, sorry, but
yeah,
a lot of listeners probably know I love economic history and market history, and you know, interesting stories from places and times where there's been really exaggerated or extreme cases of hyperinflation, and you know, you hear about factory workers getting paid in cash at lunchtime and going to the window and tossing out their bundle of cash to their spouse so they could go to the store and immediately buy food. You know, like Germany post World War I, or you know, Argentina, Zimbabwe, some of these places have extreme hyperinflation. And there's a story of you know, after the Weimar Republic, the German hyperinflation period in the 30s there. Story about I forget who it was, going to a cafe and paying for each cup of coffee as he ordered it, because supposedly the cup of coffee was going up in price, between drinking a cup, but those are really extreme examples of hyperinflation, which of course is nothing even like what we experienced in the late 70s, early 80s period. And I think kind of flip side, so like you say, it is self-fulfilling. There's that chasing of goods and services, buy ahead, buy things before the price goes up. It does hit a certain point though, doesn't it? I've heard the flip side, there's kind of saying that the cure for higher prices is the cure for high prices is higher prices. At some point it does hit a wall of people saying, this is too much, this is unaffordable. Yeah.
Yeah, I think what you're referring to, Scott, is the point where, all right, maybe if the couch becomes $1,500, then maybe we'll look at an alternative good, a
Right.
good that can be substituted. So maybe instead of buying beef that costs however much a pound, you go for chicken or maybe canned tuna or something else like that. And again, we don't expect inflation to run away. I love, Scott, that you are a student of economic and American history. You and my dad would get along very well. He teaches history, so I'm sure there would be some good stories between you two. And I think another point you touched on too is inventories. And when you're evaluating when is too much, and can prices go too high, we expect that if retail inventories were to decrease, so when you go to Costco and they actually have I forget, what was it? It was baby formula or toilet paper or regular other goods, and they're not sold out. That also acts to decrease inflation and reduce recession risk. And then the final piece here, and this actually touches to the story, Scott, of the person who retired, became a lifeguard. We think that we estimate if 1 million Americans return to the labor force, then that helps us in avoiding a recession. So it's not uncommon for people that have recently retired to come back either in a part-time or a different industry as a role. And I know certain people have even delayed retirement in order to stay a part of the market and contribute within the labor force. So one thing that I'll point out as we think about risks of a recession and how we can avoid them is that in order to avoid a recession, we need to check all 4 of these boxes. It's not a multiple choice test. It's not like the CFA, it's all of them. All 4 of these need to happen to avoid a recession.
Mm-hmm. Yeah, it's interesting. I mean, 1 million. So what is the population of the US? 300 million, give or take, something like that. So, well less than 1%. Now, I'm not sure how many of those people are employment age, but like you say, older Americans returning. The inventories, we're seeing headlines of some retailers, how quickly it shifted from supply chain issues and shortages to now some of the major retailers, as a senior buyer from a company here in the cities, they're having excess inventories and inflation, seeing some headlines about the rate possibly slowing. So very interesting. Let's hope we can check those boxes, or at least it's a mild one. Yeah.
Yeah. And I think one thing I'll add to that, Scott, is there's a lot of uncertainty as we approach the economy and the markets. I think, and I actually had the thought this morning as I was riding my bike to the gym. Usually it's really clear, can see blocks ahead. It's a great bike ride, but today it was really foggy and I couldn't see a block ahead of me. It was foggy. I was just kind of going. I feel like that's kind of where we are now in terms of our economic state, where the markets could go, is there's a lot of uncertainty. It's opaque. And I think we're going to have to expect volatility going forward based off of that uncertainty.
And there's another old saying that the markets hate uncertainty. That's kind of these truisms that when investors feel that the future is unclear, we like to stay invested. We like to stay disciplined. We think it's very, very tough game. Roz talked about difficult to outperform the market as a whole. I think it's very, very difficult, even more so to try and time the ins and outs as opposed to sticking with a good game plan. But a lot of other folks, there's a lot of trading that happens when there's uncertainty, the feeling that they don't want to stay in. Kind of to that tune, is there any particular areas of the market that you're seeing that look more attractive, more reasonably valued, more of a valuation buy, or ones that are more risky. I think that's been one of the very interesting stories for me for the first half of 2022 is, the great disparity in terms of, you see the headlines, you hear what's happening in the news, losses. It wasn't, we've been telling the story for quite a while, a few years now, of really looking and seeing two different markets, say within the S&P 500, growth stocks, meme stocks, FANG stocks that were getting so much attention, valuations getting pushed way up and a lot of dollars chasing those, versus the more sort of traditional value-oriented type companies, what a chartered financial analyst might consider a value company, and looking at that share price where it's being traded at being more justified by the book value and the earnings per share and the profits of the company. And it was really a dramatic difference in terms of what happened so far year to date. What are you seeing now?
Yeah, and it's a great question. And I think when I reflect on our conversation and a lot of the conversations we have, it's not the most positive and uplifting story that I've been sharing. High inflation, recession risk, things don't really seem that good, but there is an upside. Like I said, there's no such thing as free lunch, but there is compensation for risk that you take on. And that compensation you take for risk that's going on right now. And the upside of this situation and scenario is that we've actually increased expectations for all major asset classes. So I'll share my screen here because I think it's a cool visual to show the differences across the global market. So US foreign equities, US foreign bonds, and the yellow bar is our expectations coming into this year. So in January and December, where we thought 10-year returns would annualize. The market has pulled back in fixed income and equity. It's been a difficult time to be an investor, to look at your account balances. The upside is that expected returns over the next 10 years have increased significantly. So in terms of the broad market and risk assets, we think now's a great time to be a long-term investor, to have a plan and to work with someone like you, Scott, to continue work, like sticking with that plan. So overall, we expect that over time, certain areas of the market will outperform, some will underperform. Value and growth over the past 10 years had a fantastic run up. We think we're at the beginning of, call it a 6-year value cycle, where value will outperform. The US market has outperformed the international market over the past 10 years. We expect that to inverse as well. So international expected return is higher than US. That being said, at Vanguard, as Roz mentioned, we are long-term investors and we are careful about a couple of things. And one of that is maintaining the plan and the approach and sticking to that plan, which is why it brings me and Ross so much pleasure to work with people like Scott that are meticulous, thoughtful, and have your best interests at heart when creating that financial plan and creating your asset allocation, so that when times like this happen, when we have that doom and gloom conversation about inflation, recession risk, that you can listen and you can become educated, but you don't feel like you're not on the right path, because working with Scott, working with your advisor, you're on the right path.
Well, thank you. Appreciate those comments. I almost feel bad doing this, John, but I'm going to do it. I'm going to try and pin you down now after you said all those nice things about me. So you've said a couple times, there's no such thing as a free lunch, the famous economist saying, I like that one. But we just talked about the idea that international stocks have lagged for so long, and the difference between growth and value. And part of what we're talking about there is to be kind of careful of us using sort of pro-type language in the way we think about markets, but we do tend to slice and dice the markets in these different types of categories. And one of the reasons that we do this is, it's very intuitive when you talk about investing to think about what type of return you might get, the expected return. And then hopefully people are thinking, well, what risk might be involved? And often what we're really looking at is what type of volatility. So risk, return, volatility. But there's a third key point there that we try and build into our portfolio structure when we're designing portfolios, and that is the diversification impact. You're looking at not just the hot growth stocks, but value-oriented stocks, and not just U.S. stocks which outperform, but international stocks. And so here's my question. This is where I'm going to try and challenge you. Is the diversification effect of a free lunch?
Yeah,
In
it's
that
a great.
over a long haul, you get similar or maybe even better returns, depending what time period you're looking at, with lower volatility by having a well-diversified portfolio. Is that kind of a free benefit to an investor, or is it not?
I love that. I love that question, Scott. And I appreciate you challenging me. I think we actually have been through an interesting point where a lot of people would say that the benefits of diversification, the benefits of holding bonds in addition to fixed income, like a 60-40 portfolio, or diversifying international, diversifying between value and growth in different types of sectors in the market, that they would say that the value of that diversification has decreased based off of the past 6 months, where we saw equities and fixed income both post negative returns. We believe that, to answer your question, Scott, like, diversification is a form of free lunch. It's a way that you can set yourself up. So maybe the economist in me is saying, oh, I don't know about that. But the investor and the market participant is saying, if you diversify properly and you get exposure across what's doing well right now, what's not doing well right now, and you have an asset allocation and you stick to investing principles like goals, balance, cost, discipline, you can take advantage of reduced volatility, so less risk in the portfolio, and increased returns. And that's a function of the negative and low correlation between different asset classes and different sub-asset classes. And that's really where the beginning of the benefit of working with an advisor to make sure that you're not missing out on any of these free lunch kind of portfolio construction ideas. So yeah. Scott, I love that you challenged me there, and I love that you added nuance to that.
Yeah. Well, good. Well, thanks, John. All this lunch talk is getting me hungry. But before we wrapped up, Roz, I wanted to come back to you. There's an interesting study that Vanguard has worked on for quite a while called the Advisors Alpha Study. And I think it's interesting in my mind for a couple reasons. Vanguard, and maybe I'll just frame it up and you can explain what's going on there. But Vanguard's tried to take a look at financial advisor and where we are able to add value. And I think it's in part, it's a very useful tool for me and folks like me to say, well, how should we be structuring our business? How should we be managing our activities? Where should we be putting our emphasis? Where is there real value to be added? And where is it very, very difficult to add value? And I also think it's interesting, in my self-interest, I think this is a good study, because when you hear Vanguard, you often hear that put out in the context of do-it-yourself type investors. And I think a lot of people can do a very good job doing it themselves. But Vanguard, as you described up front, is a company that is essentially owned by its own investors. So it's not like there's outside shareholders or some type of special profit motive to encourage this type of study. There's no reason for it at all, other than, I guess, trying to figure out, is there value there and where? So could you kind of give us a high level on what this study is and how long it's been running and how it's compiled and I guess some of the
Yeah. So a piece of being an investment management firm, Scott, is putting out thought research on all different topics as it relates to investment management, as it relates to advising, financial planning, et cetera. And so we have a team called our investment strategy group that all they do is write research, right? It's very academic. If you think about a college and the way universities pump out research, like most asset managers, most investment managers do the same on different types of concepts. And back in 2001, when we really formed the financial advisor group within Vanguard, the group that John and I sit in that work with financial advisors such as yourselves, we put together a study from this investment strategy group that talked about the value that we believe advisors bring to end investors. And really the rationale for us back then was most investors think about Vanguard as just being a retail do-it-yourself shop, right? Back when John Vogel founded the firm, that was all we had, right? Was a retail department that, so if you were a do-it-yourselfer, you could come to Vanguard, log on for an account, sign up for an account, and manage it there. We, after that, launched an institutional division. And when I joined the financial advisor group back in 2008, we were still under the institutional division. You fast forward now, and I think I mentioned this earlier, if not, advisors such as Cahill and other financial advisor partners such as you, they make up 40% of Vanguard's assets. So you are Vanguard's largest client. So your end clients are Vanguard's largest clients instead of the retail do-it-yourselfer. And I say that to just set the backdrop for back in 2001, when we joined this business, we felt like we really needed to help advisors have better conversations with their end clients. And what better way to do that than have Vanguard come out with a study that talks about the value we believe financial advisors can bring to their end clients. And I will start by saying that was the thesis, right? That was the hypothesis, excuse me. But then we had to actually put the research together to say, is this really valid? And we've iterated on the research since 2001, but really it comes down to a module of 7 different things that financial advisors such as yourselves do that most end investors do not do on their own. And a lot of it, Scott, just comes down to time, willingness, and ability. Number one, do you have the time, right? If I think about all the things that you do for your end clients, whether it's, researching the markets, meeting with people like John and I to understand what's going on at Vanguard, to understand what's going on underneath your funds, to set financial plans, to review the options, to rebalance the portfolio, to trade the portfolios, all of the things that end investors most don't have time to do in the way that advisors do. That's the time. It's the willingness, right? So I hire a cleaner. I have a toddler, and my husband for a long time didn't believe that we needed a cleaner, and I realized that's because I did most of the cleaning, and so of course he doesn't think we need a cleaner. He's great at picking up, not always great at mopping or doing things like that, but my willingness to clean on my time off of work is very low. And so for an investor that might have the time, are they willing to do it? Are they willing to sacrifice spending time with their family or doing things they love so that they can instead be researching investments or researching the markets or rebalancing their portfolio, et cetera? And then the third piece is the ability. John used a lot of really fantastic family examples. My dad is a retired mailman. He thinks he knows how to pick stocks. And so I would put it in the ability category. My dad has no idea how to read. I don't suggest most people pick end stocks in and of itself, but right. Especially right. My dad with his, high school degree. So most of the genesis of our research went to that. Some of the things I already hit on is what are the key pieces, which is asset allocation, right? You said an asset. Most end investors pick individual funds instead of first thinking about what's the right mix of stocks and bonds, because 90% of your returns of a portfolio are driven from your asset allocation, that mix of stocks and bonds, and not the underlying investments. It's once you pick your stocks and bonds, then you pick the underlying investments. Are you doing it in a cost-effective way? Are you placing them in the right accounts, right? So are you putting funds that pay out a lot of capital gains in your qualified or your tax-deferred accounts? Are you putting your really efficient index funds in your taxable accounts when the markets are really running, right? So this year isn't the perfect example, but back in 2020, when the equity markets were down 35%, were you selling bonds and buying stocks, which is an incredibly uncomfortable thing to be doing? But I know that's something you were doing for your clients. Mm-hmm. And I'll just hit on 2 more because again, there's 7 of them. I think withdrawal order is one that most retired people don't think about. So you've saved your entire life in your 401k and in your IRA. And so when you retire, it's very intuitive to think, well, that's my retirement account. Why wouldn't I pull from that? Well, we know that's actually really tax inefficient. You pull from your taxable assets first. And so that's a big thing that advisors do. That's a big thing I know you do for your clients. And then the biggest piece of what we believe advisors do for end investors is this behavioral coaching, right? It's when the markets are really falling, when it's really uncomfortable. How do you keep people invested? How do you think long-term and think strategically? It's really easy. And John had mentioned this earlier, from 2008 to essentially 2020, we had a really good run in the economy. I mean, there were a few blips here and there, but most people didn't feel like they needed an advisor because the markets were going up. So there wasn't this jump off that you feel when the markets are in a free fall. And unfortunately, most people only remember the moves that happened instead of the moves that could have happened but didn't. So I'm sure, Scott, I know you spend a lot of time coaching your clients, but I'm sure there were a few that called that said, this is uncomfortable. I have to get out. I think I think the economy is never going to come back. And nobody notices, if I would have sold out then, where would my account be? Right. So we only notice and we only keep track of the moves that actually happened. And so it's sometimes hard for end investors to understand the value because they don't see what could have happened had they made moves. I'll just end by saying, anybody who can see me can probably guess this. I'm 40. And so when 2008 happened, I was in my late 20s. I didn't have a lot of money, right? I was, fresh out of college, just started investing. So 2008 was painful, but it wasn't painful in the way that 2020 was. And so I thought I knew my husband and I have been married a decade now, and I thought I knew him really well. And then 2020 hit and I learned his real risk tolerance. And on a daily basis, he told me how we needed to be selling out and moving to bonds and how the world was never going to come back. And so I think to myself, those are the moments when advisors really save investors from themselves, in addition to all the other things you do on a regular basis.
Yeah, I think, I appreciate that, Roz. Sometimes I think about there's the professional training, talking about the chartered financial analysts and degrees and designations. That's the baseline, the technical knowledge. All right. And then I think there's experience. Have you been through 2000 to 2002? Have you been through 2008? Been through 2020? Living it, feeling it, knowing what it's like. But then, like you can see it in so many different fields. Sports, of course, is an obvious example. Having someone outside yourself with some knowledge and some experience, hopefully a lot, who you respect and are willing to listen to can be tremendously valuable in many areas of your life. And I think that's a big part of it, just having that sounding board that's outside. The emotions are somewhat detached. And Warren Buffett, I don't recommend that many people try to mimic his investment style, but I think there's an incredible amount of wisdom that can be learned from his investment temperament and his sort of philosophy and his mindset towards money and investing. And he has a saying that investing is like dieting. It's simple, but it's not easy. And sometimes I think about that type of concept. Like, hey, most of us could probably be in great shape if John talked about going to the gym. If you eat pretty well, and I think most of us have a pretty basic idea of what that involves, and you get enough sleep and you get some exercise, and you can go jogging and do push-ups for free. But not everyone gets there, okay, right? And oftentimes having that professional trainer or a structured program, some discipline, a process, back to your time, willing, and ability and willingness, Roz, it's a big part of it. So I do have to ask, what does it all come to? Vanguard actually is trying to quantify these inputs, right?
Yep. So Vanguard's research will tell you on average, we think advisors add 3% to client returns. And so, Scott, what I don't mean is the reason that we believe advisors that employ those best practices that I mentioned can add 3%. It's not an annual number, right? In a year like 2020, when you kept clients invested when they could have sold out on their own, in that year, you might have gotten them 15% more. So it's 3% more than an end investor themselves would get because of the things like tax location and asset allocation and so forth. So in the industry, we use the word basis points. We say 300 basis points. For end investors, we would say we believe advisors add about 3% to returns on an average basis.
Yeah.
So it's a really significant number, right? 3% is a pretty big deal. And we put the initial quantification back out in I want to say 2013, and we actually just redid it again this year. And we still came up 3% or more is the number that we've come up with now.
Pretty consistently around that number.
Yep.
So of course, as a career-long professional in this field, I love that study. I think it's fantastic. But I'm also skeptical of it. Even sitting in my seat, just think, boy, that I don't know. That's a big number. But I think it's like you say, when you look at long-term relationships. I've worked with some people back to 2000. I've been in this field since the late 90s, and it doesn't always happen at once. And everyone's situation is different. Sometimes there's tremendous value to be added in terms of lowering cost. The tax structuring is is just an incredible part of it that, if you're not doing that on your own, or whoever you're working with is not doing that, it's really something to be looked at. And I like to say, oftentimes we view portfolios like a tic-tac-toe board, large companies, mid-size, small, growth value, that style box that Morningstar helped make popular. When you add that tax location decision, not just what to own, but where to own it, and you look at what dollars are available between a Roth IRA, a taxable brokerage account, tax deferred like 401k or IRA, and then what the investment options are, because sometimes there's constraints. It goes from playing tic-tac-toe to trying to solve a Rubik's Cube. It really becomes more of a three-dimensional plus decision. And there's tremendous value to be added there. And one of the things I'm waiting for, as fintech, financial technology evolves, none of that shows up on the tax return. Just like you said, Roz, sometimes the most important decisions, the best decisions, are the decisions where nothing happened. You did not sell, you did not panic, and it was a conscious decision to not do that. Those tax savings, they don't show up. You get an investment return that shows investment performance, and you get a tax return over here that shows tax bill. What I'm waiting for is the linkage. I need to find a smart guy who can help me write this, where it actually shows, the impact for each person of those, the after-tax versus raw returns that would have been realized. So,
it's a big difference.
Yes. Yeah, definitely appreciate that. And I see we're about out of time now. But this has been great. I really appreciate Roz and John, the two of you joining us, and appreciate the type of work and research that you do for us at Vanguard, and the consistent excellence in service and the offerings. And thanks for sharing the insight, John. I really appreciate the economic and market insight. And Roz, great talking with you as always. I also want to thank the team at the office for helping set this up and coordinate it. And I guess would say again is, anyone who's listening, any specific questions as to how any of this relates to your individual portfolio or financial plan, please feel free to get in touch and we'll follow up. So thank you.
Thanks for having us, Scott.
All right.
Thanks,
take care.
Scott. Take care.
Bye.